The trading week is wrapping up, and we had plenty of economic data releases, earnings, as well as the final presidential debate. Joining me on the trading floor is Keith Bliss of Cuttone & Company. Keith, thank you so much for joining me.
It's great to be with you, Remy.
Well, we had plenty of economic data, central bank rhetoric, as well as earnings, and of course that presidential debate. So what do you make of this week?
Well, this week it had something for everybody, but the market didn't really move all that much when you look at it in the final analysis where we are right now. But you're absolutely right. Earnings, we're in the real heart of the earnings season right now. As we've gotten through all the financial institutions, we'll start to roll into some of the technology companies next week, and then we'll get the retailers in the second, third week in November. So we're starting to get into that. The rhetoric and the conversations and the speeches from the Fed continue unabated. I've been fond of saying in my next life, my next job is going to be the press agent for all the Fed speakers and the Fed governors, because they're the busiest people in the world right now. And they do move the markets, and that's why you have to pay attention. And then, of course, just dealing with the overall market dynamic that we have and the presidential election now that we're less than 3 weeks away from the vote. It is adding up to a real hodgepodge of information that you've got to be very careful how you dissect it to maneuver inside of this market.
And indeed, we have plenty of event risk coming up in the next week, as well as the upcoming weeks, especially with the election. And this week, we got the Fed's Beige Book. We got some commentary out from Fed speakers, and we saw the markets sway, as well as the currency markets and equity markets after ECB Draghi spoke. But what do you make of global rate differentials, and how does that play into your overall outlook?
Well, it's going to be an interesting tightrope that the Fed is going to walk. I think everybody here, and you can see it in the Fed Funds Futures, agrees that a December rate increase is coming, albeit it's going to be a modest one, a quarter point. We understand that, so that'll raise the short-term Fed Funds rate to 3/4 of a point, probably bump the yield curve in aggregate up a little bit. But it is the tightrope that the Fed is going to have to walk is that you're right. They have disparate monetary policy compared to the rest of the world. And some of the economic data coming out lately has not been all that positive. It's been a mixed bag. So are they sending us into a rate increase during a slowing economic cycle? We still have to see if corporations can turn the corner on earning more money. This will probably be the sixth straight quarter that S&P 500 earnings will be down year on year. So it's a real tenuous time for the market, for the companies, and for monetary policy globally. So I think we're going to see probably the markets continue to move sideways, outsized volatility from day to day when it comes back towards the end of the year. And again, you're going to be able to pick your spots and make money, but a longer-term trend is indiscernible at this time.
Keith, you mentioned the S&P 500 as well as forecasts out from some of the companies reporting earnings this week. Before this interview, you were talking about the presidential debates that you paid attention to in the past. So when it comes to market bubbles, I'm sure you've seen a couple of those. Do you see any bubbles right now, whether it be the equity markets, the bond markets, or just any sector in particular?
Well, it's an interesting question as it relates to the equity market because investors have been willing to pay for increased multiples inside of the equity sector for some time, and the earnings just haven't supported it. Now that we see, and a lot of that, investors being willing to take on the additional multiples has really been about stock buybacks inside of the companies. They've been supporting the market for a couple of years. It's not unusual to see in a world where you have zero interest rates, very cheap money floating around. Capital goes where capital is rewarded, and right now when companies are flush with cash, they go buy their stock back, increase the value of their ownership in their stock, and make their earnings performance look better on a price to earnings basis every quarter. That seems to be coming to an end. So the question is has the equity market been in a mini bubble? I won't say a large bubble like we saw in 2000, and is therefore some of that air going to come out in the form of a 10% correction? Can certainly make the case for that. The one counterpoint to that is when you look at all the asset classes and all the markets around the globe, U.S. equities is really the only place to put the money. It's really the only place where you've gotten any kind of yield outside of the Saudi bond offering that they did yesterday, which has a yield above the U.S. interest rate curve. But nonetheless, overall, in an aggregate, I think U.S. equities will still be safe for the foreseeable future, regardless of what happens with the election, regardless of what happens with company earnings, regardless of what happens with monetary policy. You'll probably see this market stay up.